Your wealth deserves stability, expertise, security. Your wealth deserves LGT Crestone, private wealth with over a century of global heritage.
And welcome to the Global View on this Wednesday. Thanks for joining us here at Ausbiz. Well, let's take a look at the macro picture. Investors are looking ahead to economic data out later this week, ahead of second quarter earnings in the States, with minutes from the Fed's last policy meeting out tonight and a raft of US job numbers to follow. Also on the watch list are fresh developments in the US-China trade war, with Beijing restricting exports of some metals used in semiconductors, electric vehicles and high-tech industries. China will ban the exports of some gallium and germanium related products to protect national security and interests effective from August the 1st. That move is seen as a response to escalating efforts by the United States to curb China's technological advances and comes ahead of a visit to China by US Secretary of Treasury Janet Yellen. Metals analysts say it's possible China could also impose restrictions on rare earth exports. China is the world's biggest producer of rare earths, which are used in EVs and military equipment. And Australian rare earths producers rallied on those developments yesterday with shares in Lynas, the world's largest producer outside of China, up 4% for the day. Now in Europe, German exports fell unexpectedly in May as exports to the US and Russia fell sharply. German two-year yields, they held near 15-year highs, as traders globally positioned for interest rates to rise further and stay higher for longer. And in the currency market, the US dollar index was flat while the euro dipped slightly. And the Aussie dollar, which fell around 0.4% after the Reserve Bank left rates on hold yesterday, has bounced back on expectations that the RBA will deliver at least one more rate hike in the current cycle. The market there implying a 50-50 chance of a hike to 4.35% in August. All right, well, stateside, Nike has reported full-year earnings, and Adam Chandler from Claremont Global joins me to discuss his thoughts on that result, what he's telling him about the state of the US economy, and perhaps we'll get some portfolio positioning as well. Adam, great to catch up with you. Thanks so much for joining us from Claremont. All right.
Good morning, Andrew.
So, of course, we had markets closed in the States overnight, but what trends are you seeing there, I guess, particularly given the current macro environment out of the States? What are you watching for?
Well, Andrew, I guess we're only halfway through the year and already we've had fears of a banking crisis, US default, and aggressive Fed tightening, yet the market's still going up. And that clearly reflects positioning and sentiment, which was pretty low coming into the year. But to us, it really just highlights how hard macro is to call. And then even if you get it right, you've got to call the market right on top of that, how the market will react. So we really step away from that and try and focus more on the companies, focus on fundamentals and focus on valuations.
Well, in fact, I gather what you just have returned from a trip to the States. What was the sentiment that you gauged when you were there?
Probably what stuck out the most, Andrew, is just the different perspectives that we're seeing in New York versus the rest of the states. So if you speak to the investment bankers, people in private equity, commercial property, we sat down with a number of professionals across those industries, and the mood is a little bit gloomy. They've clearly been impacted by higher rates and where there's financial transactions involved, particularly larger ones. There's been some sand thrown in the gears from those higher rates. Sellers are obviously looking at prices where they were 2 years ago, which they'd like to realise, and buyers are more focused on their financing costs and the potential for more volatility. So there's a real difference between perspectives from Wall Street to Main Street. And you're seeing that also in some of the announcements, which we're seeing from investment banks, investment banks cutting staff headcount going down, yet on the Main Street, still almost 2 job openings for every person that's looking. So real difference there. And I think it's just a reminder to not look so much at the headlines, but sort of get into the real economy and what's happening behind what we read in the press.
Yeah, and I guess you can also dig into what we're seeing at a corporate level at the moment, of course, ahead of earnings season. Adam, I was mentioning there at the top, Nike. Do you regard this as something of a bellwether for the US economy? Because it did report fourth quarter earnings there, showed a slight miss on EPS, but it did exceed revenue estimates. What are you seeing going on there?
I think the key takeaways for us is that demand remains strong. So we're seeing solid top line growth. For the quarter, that was up 8% in constant currency terms and 16% for the year. So really strong demand. But Nike has experienced some margin pressure. And part of that relates to what we saw coming out of COVID. So we saw inventory markdowns. There's been some clearance activity there. Freight costs are still elevated, although coming down. And then we've also had the impact of the China lockdowns. So for those reasons, we see Nike as under-earning at the moment. But then when we look out longer term, we see potential for real margin improvement. And a key part of that is Nike's direct-to-consumer strategy. So they're doing less wholesale and more focus on online sales and through the Nike stores. And the big benefit of that is that it helps increase margins. We saw further progress of margins of that direct-to-consumer strategy working this quarter, but the margin progress has been held back by some of those short-term pressures, which I just mentioned. I think we've got to take a longer-term view for Nike. We're not focused on necessarily just what happened in this quarter with margins, but think about that strategy over the long term. And to successfully execute it, you really need scale, brand strength, and pricing power. And they're all things which Nike has. So it's going to take time for the margins to increase, but we can see the potential for significant margin expansion over time. Now, in the shorter term, as I said, some of those pressures which we have seen, inventory is starting to be cleared. They're making good progress there. Freight costs are coming down. And China, during the quarter, we saw great growth. That was up 25%. And also some of the FX pressures that they've experienced are starting to alleviate. So we think it's a good long-term story there. Probably less focused on what it means short-term for the US economy and the US consumer. I think Nike released a rather conservative outlook for sort of mid-single-digit growth this year in the top line. But overall, we really like the story and can see the long-term potential there.
Adam, it does sort of straddle retailing and manufacturing. Does that inform you perhaps on what's going on in those sectors at the moment?
We do focus on a range of different companies in different parts of the economy. But to put it in context, we're not looking at cyclical companies. We very much have a focus on companies which have more predictable longer-term returns. And so we want companies with dominant positions, strong pricing power, strong margins, and really solid balance sheets. I think what we have seen as we've gone through the last 18 months is these types of companies have continued to outperform. There's been a lot of talk about recession. It's been very well telegraphed. At some point, we will have a recession. We just haven't got there yet. What we think it's really important for investors to focus on is having those companies that can weather all conditions.
So just in terms of portfolio positioning, Adam, interested to get your view on those AI-related stocks. We can't escape that, can we, given the outperformance and how it's driven the broader market too. It is something of a frenzy there. How are you approaching those stocks at the moment?
So we have a number of large tech holdings within the portfolio. That includes Microsoft, we've got Adobe and also Alphabet. We think all of those are positioned well for AI. I guess the key things that we're looking for there are scale advantages. And obviously, the operators, the hyperscalers of those large clouds have an advantage when it comes to scale. We think that's going to be important with AI as well. And obviously, the data which they have. We're very focused on the potential for monetization of opportunities. And why I say that is, like, traveling through the US, we listened to over 50 companies and management teams talk, and we didn't have a single meeting where people didn't mention AI in one shape or form. But for some companies, speaking to people in the quick service restaurant industry, when they're talking about AI as it relates to burger flippers, it seems to be a bit of a stretch. So what we're looking for is that near-term monetization potential. We want to see the evidence that they are actually able to monetize. And obviously, they need the infrastructure and the scale. So we really play it on the larger side of tech, and I think probably pretty conservatively relative to some of the options that are out there for getting involved in AI. But that's how we're thinking about it. In terms of what it means for the market, those companies have had a great run, and while the market has gone up, one of the more interesting things for us as stock pickers is we're seeing good dispersion. So while tech has done really well, consumer has lagged, and that's the opportunity for us as stock pickers. And we've recently added a consumer name to the portfolio because of that dispersion. And I think for those people who are watching the market closely, there are opportunities, despite the fact that the market has gone up a lot, if you pick your spots.
So what you think, in the consumer space there, that bad news is pretty much priced in at this point?
I think for certain companies, yes, that's definitely the case. And some of the things which flash up on our value screen certainly are within the consumer sector. But once again, it comes back to making sure you do it in a way where you're with companies that will be able to survive a downturn. So I guess where we separate ourselves is we're thinking in terms of years rather than trying to pick a company which will buy today and sell for a profit in a month's time. You really want those companies which can travel through a recession, and you're confident that they'll have the balance sheets and the financial model and the business model to withstand whatever the market throws at it.
Adam, terrific to get a view of your strategy there at Claremont Global. Thanks for joining us.
Thanks, Andrew.
All right, that is the global view for this Wednesday. Just before we go, a check of where we're likely to get going. As you can see, their SPI futures are off close to 0.1%. That's after a bit of a flat session globally in the absence of any trade out of the States because of Independence Day. All right, stay with us. The Open is just around the corner.